Joining us for a conversation is Dean Taylor of Diamcor Mining, which is focused on supplying rough diamonds to the world markets. Mr. Taylor, thank you for joining us today, sir.
No problem. Thanks for having me.
Well, it's a pleasure to speak with you today as Diamcor Mining has some important news for shareholders regarding operations and a corporate update on the flagship Krone-Endora at Venetia Diamond Project. Before we begin, Mr. Taylor, unbeknownst to most speculators, the diamond space has been attracting Prudent Capital that is seeking companies that explore and mine for diamonds. Sir, for someone new to diamonds, please provide us with an overview of the current state of the sector and perhaps why this may be an opportune time to consider having exposure in the diamond sector.
Right. I think as we've discussed before, Maurice, 2023 was a bit of an odd year in that what we've seen was really a buildup after COVID, where luxury spending, gem quality diamonds, that stuff. There was sort of a pent-up demand where the sales were quite exceptional, and that continued on sort of into the middle of first part of 2023. And then what we sort of have seen is a bit of overstocking where guys continued to buy. The Russian market, obviously, with the conflict there, there's some new sanctions coming in, but largely that product was being sold at a discount. Just a lot of different variables, and as we sort of seen things kind of uncertain with the U.S. market, which is the largest market, and then the failure in terms of the growth, what was expected in China, the numbers kind of dropped off, and it created this sort of oversupply per se of diamonds, which drove the price down. We've only seen it twice. We saw it at the financial crisis, and then we saw it again as we moved into sort of an area or a time when COVID happened. Both times it bounced back very, very quickly. And what we've noticed is that this we expect kind of to be more or less similar in nature. So it's a bit of an interesting time. I mean, the bottom line with everything is that we know that there's basically only about 1.3 billion carats of reserves throughout the world. About 600 million of that is in the Russian market. So therefore, as we see these sanctions come in, that could have an impact. And the world goes through about somewhere around 120 million carats a year. So really, when we look at it, it's not a well understood, industry. But the reality is that gem quality natural diamonds are certainly becoming harder and harder to get, more and more rare. And so while we see this sort of low point right now, I think we're going to see, as we get into the end of the first and the second quarters of next year, these supply shortages for natural rough diamonds is going to increase. And we've already seen a little bit of a move at the end of this year where the buyers have started to restock and things like that. I think what we're going to see is it comes down to sort of how good are the Christmas numbers going into next year. What do we see in terms of recovery in China? But overall, it is an interesting time, and I think we've sort of seen this third, in at least recent history in the last sort of 15 years. This is the third time. Every time it bounces back quite strongly. So I think that going into next year, it's going to be interesting, to say the least.
Well, going back to Russia here, I know a lot of the speculators that are in this space have marked their calendars for the 1st of January, and you've alluded to sanctions. Can you expand on that narrative a little bit further for us? And who are some of the key players that have benefited prior to this, to the 1st of January coming up, and who will benefit moving forward?
Well, I think, what had happened was obviously, we don't get too much into the politics, but obviously the conflict between Russia and Ukraine is something that was at the forefront. We saw earlier the G7 countries, which are really where the main brunt of the sales takes place. The U.S. market is well over, around 50% of what's sold in terms of luxury goods and certainly diamond jewelry and things like that, and the higher end stuff. What we saw was G7 came out with what I would refer to as more or less bans around the middle, just before the middle of this year. They were largely ineffective in that Russian goods were still coming in. They were being bought, and most of the stuff was cut and polished in India. And the theory was, well, even if it originates in Russia, if it's cut and polished in India, then it originates in India, and that has gone by the wayside. A lot of the bigger guys, your Tiffany's, your Signets, a lot of the mainstream guys, they're very, very, aware of their corporate social responsibilities and things like that. They came out pretty much right away and said, look, we're not interested in having anything that originates, from Russia. Now, what's going to happen is the initial bans, as we would call them, or sanctions, have been strengthened now, and what will happen is really the January 1st number is when they'll kick in. There's some initial stuff. It required sort of cooperation from the Indian side, which they've gotten. And what we're going to see is as we move through this year, not only after the first, is there going to be, pretty serious sanctions where there's no way that anybody really wants to, have Russian goods in their stores right now. And so what we're going to see is as that moves forward through to the middle of the year and into the third quarter, there'll be additional tracking, additional things that'll go into place to kind of eliminate that. So the key to remember is that, the two big players in the industry are De Beers and Alrosa, which is the Russian government. The Russian government, Alrosa, is somewhere around between 30 and 35% of the production worldwide. So if you take 120 million carats and you eliminate, 35% of that, yes, those goods will still end up going to China and different areas like that may not care as much. But the reality is that we do believe that, we're going to see some shortages. Synthetic or lab-grown diamonds, those have, they represent about maybe 15%, of the space now. Everybody asks that question. The synthetic side of things, it's very simple. I mean, natural gem quality diamonds are extremely rare. They're created over 1 billion years by the earth. They're natural. It's very, very hard to find. They have an absolute store of value, and they continue to go up in value. Synthetic, when you talk about lab-grown diamonds, things like that, I mean, they have a place for, more or less, costume jewelry, that type of stuff. They're fine. But for special events and things like that, people gravitate towards the natural gem quality. The synthetics, it's hard to compare the two. If we look at it, I mean, you've got something that's created like a piece of art. It's very rare. It's created over 1 billion years. A lab-grown diamond is more like a print. It can be grown. Most of them are grown in China, and they can be created in weeks. So there's no real value proposition or ability for it to hold its value. And people obviously gravitate to luxury goods and rarity and things like that. So the space is from a supply demand scenario, we've always thought that just the amount of diamonds that we know are out there from the main mines, that would ultimately lead to difficulties in terms of supply and getting a hold of stuff. The sanctions tend to maybe accelerate that somewhat, but overall, going forward, there's big mines that are going off. There's nothing new coming on. So, really the supply demand thing and the shortages that we see coming, and we've always seen coming, is something that I don't think the general public understands.
Speaking of what the general public may not understand as well, is that many of our audience members are used to grams per ton in bullion, but in the diamond space, as you alluded to, there's a difference in carats. And could you talked about the synthetic and you talked about gem, but what about where does rough and industrial diamonds fit into this narrative, so we can kind of get a better understanding here?
Yeah, the other things that we look at, or that people should look at, is, as you say, diamonds are interesting. It's a very unique sector in that when you look at a diamond mine in general, or let's say we look at the entire, this 120 million carats a year, that, it was about 135. It's gone down a little bit now to where about 120 million carats is being supplied a year of natural rough. I think most people would be surprised to know that really only about 20% of that is gem. About 80% of it is industrial. used for semiconductors, cutting devices. It's the hardest material in the world. Drill bits, cutting, polishing, all that kind of stuff. So it's very, very hard to find, gem quality natural diamonds. It definitely, when we look at the lab grown diamond sector, it's gotten consistently, cheaper. It's more, we see it in the places like Pandora and different things like that, where it's, it's a birthday gift. It's something maybe not quite as meaningful as, say, an engagement or otherwise, where people want, something that actually has, real value to it. Look, our project is about 60, maybe 65% gem or near gem quality. That's one of the nice things that we have. As you say, when you look at it, it's, typically we look at carats per 100 ton. You can still look at it in terms of what your targets are for, say, your revenue per ton as opposed to your operating cost or your all-in cost per ton. But as you go up in terms of gem quality, the numbers obviously change. The more gem quality you have, the better it is. When we look at the overall picture for all diamonds that are recovered, the average dollar per carat, again, people might be surprised to know it's probably under $100, probably $90 to $100 on average. Last year we had, we get some big stones and things like that, but we were well over sort of $350 a carat. So about 3 times what you would normally see is what we're looking at. And the big stones, like I say, for us, we expect to see some stuff over, up to sort of 300 carats in size and individual stones. So those can be, depending on the quality of the stone, they can be 3 million, they can be 5 million, they can be 15 million just in one shot. So that's really what we focus on is, we focus on the higher end guys. We have about 200 customers. Of course, we've got the strategic alliance with Tiffany's, which is now part of Louis Vuitton. But really, our buyers are looking for that very unique, very rare gem quality stones that are obviously very, very valuable. And as they become harder and harder to find, they go up in value. They're not something that you can produce in a matter of weeks.
Well, let's find out where and how Diamcor Mining fits into the narrative. Mr. Taylor, please reacquaint us with Diamcor Mining and the exciting opportunity the company presents to shareholders.
Yeah, it's been a rather unique story. It takes a long time to get everything, up and running. What we did was we are co-located. And when I say co-located, our processing plants and stuff like that are probably within 1,000, 1,500 meters of the main pipe of Venetia. Now, Venetia is obviously one of the most prolific diamond mines in the world. It's owned by De Beers. It was producing somewhere in the neighborhood of about 9 million carats a year from the open pit operations. It's now gone underground, drops probably that production level down to about 3 million. And essentially what had happened was De Beers had identified that as much as sort of 1,000 vertical meters or about 50 million tons of that tops of that pipe was pushed off in a glacial shift and subsequent erosion. So what we end up with is really a fan deposit that's very close and moves out from the pipe. We acquired about just under 6,000 hectares directly adjacent to the pipe. And so what we do is we mine out the areas through a surface mining operation. We're not underground. It's never more than about 15 meters from surface to bedrock. And we remove that material and we extract the diamonds that were displaced from Venetia. Now, the thing, if you do the quick calculation, Venetia, as we talked about with grade, is somewhere around 100 carats per 100 ton. So knowing that 50 million carats was displaced, that translates into about a 50 million carat displacement, which is 10 billion US dollars. Now, we're not going to find 50 million of those carats. Our target, we think the potential to find somewhere between sort of 3 to 5 million. Call it 10% of that over the area is realistic. It's a very low cost operation as you've got no underground, no blasting, things like that. For lack of a better term, it's a glorified gravel pit with essentially the same diamonds. So for us, the business is all about volume. We were ready to go before COVID. We wanted to ramp up at that point in time. COVID slowed us down. It was probably a $3.5 million waiting game to get through COVID. We got through that, ramped back up, and we've seen our numbers start to grow, quite dramatically. South Africa had some power issues. We ended up, going ahead and basically correcting that, by the middle of this year. And then we chose to kind of slow things down and work on the outer areas or get ready for the bigger picture of trying to advance this and make final, initial production decisions for this coming year. So that's kind of where we sit right now. But it's an extraordinary opportunity. There's a tremendous amount of upside, and I think a lot of what we see, in the stock price and the current thing is just a matter of, I think the sector overall, the junior sector is off a bit. The market's a little tough, but I think that we've ultimately always survived through these, and we've done it again. And now the focus really becomes let's get going and get ready for next year. The other thing that I think people will be surprised at is obviously this is a De Beers, project. So, we own 100% of it. We don't pay any, with our Black Empowerment Group, we own 100%. We don't pay any royalties, things like that. It was very much designed to support junior mining, women in mining. And we also have our strategic alliance with Tiffany's, which is now owned by Louis Vuitton. Tiffany is a small shareholder. They provided us with about somewhere close to $10 million originally in exchange for a first right of refusal. They don't get a discount on anything, but they definitely, it's all about supply. That's the number one game for a lot of these bigger guys right now, is making sure they have future supply and from a non-conflict, socially responsible place, right?
Well, you've said a lot here. I want to go back to Tiffany's since you left off there. Tiffany's has been an investor in Diamcor Mining pretty much from the beginning. If one reads through the financials of Diamcor Mining, one can see their impact on the balance sheet. Could you elaborate on the financial relationship with Tiffany's?
Yeah, it was done in a combination of debt and convertible debenture. What we see, and it's one of the things that we'll look to address here in the new year, something that we've been working on, and we want to sort that. When COVID happened, Tiffany's was, has been very, very good to us in the sense that we were paying down that debt quite significantly as we got to COVID, and the idea was to eliminate it or get rid of it. Obviously, with COVID, that was a net out. We, shareholders management put in probably about, and the largest guys, we put together about $3.5 million to basically survive through COVID. And at that time, Tiffany's agreed to defer that and just accrue interest. So what we see on the balance sheet that's a little bit maybe misunderstood, or that it looks like, is because there's no set terms of repayment and it's just being deferred, that shows up as a current, debt or a current liability on the balance sheet. I think as we move into the new year, we've obviously announced we're going to look at some forms of financing. It's very tough right now. We'd like to fully finance things early in the new year, right through to being able to get this outer work done and make initial production decisions for the long term. And so the goal of it will be is either to set up some sort of a amortization schedule that moves a majority of that current liability to a long term, or to replace that facility with something that is more, attractive in terms of cleaning up the balance sheet items. So a lot of what we've done now, I think, our last quarter, when we look at it after the power situation and what was going on was not the greatest. I think people are going to see a marked difference when we get into the end of the year. And then next year, as we get into the first quarter, our desire, and we think that we have the potential to, kind of be able to present to guys saying, look, we've got this sorted, we're fully funded. We've got about, we've reinvested, we've recovered about around 200,000 carats in the trial mining phase today off the initial close areas. That's generated about $40 million US that we've put back in to the project. We've probably got close to $100 million invested in this to get all the infrastructure in. So really, when we look at what funding we need from here going forward, we're really talking about, probably $3 to $5 million at the most. And most of that is really going to go into CapEx in terms of additional processing capacity, equipment, things like that. So really for us right now, the goal is get back going at the early part of the new year, get the balance sheet stuff cleaned up, be fully funded, have additional capacity in terms of processing, and ultimately from there expand into the greater portions of the project. We've only touched about about maybe 10% of this project. So there's a lot of upside and a long ways to go. And, we see sort of the ramp up or the volume as being the key. It's something that we've wanted to do, as I said, since we're before COVID. And so COVID was unexpected. It was unfortunate for a lot of people, including us. The South African power issue was also unfortunate, but we do have the ability now. We made corrections there, and we can run 24/7 without any reliance on the power now. So really, at this point, it's just about basically getting ready for the new year and ramping up, and then determining how much additional resource we've got in those outside areas, and that's going to be sort of the focus of next year. So we're overall it's been a tough year, but we're quite excited about next year, and certainly the value proposition at these levels is it's a bit ridiculous to us, but price comes to value, and once we demonstrate, we ramp up and get into next year and stuff like that. I think obviously we would assume that the stock has the potential to move up quite dramatically from here.
Well, speaking of milestones, what operational milestones or goals does the company have in store for 2024?
Well, I think that the absolute thing is we want to start out in the new year. The milestones are going to be definitely to go into that outer area. We'd like to see the ability to do an updated 43-101 in that outer area. If we can identify even on a deferred basis, somewhere between 3 and 5 million carats, then we've got, we would have to increase our processing levels by, 2, 3, 4 times. It's not expensive to do that. Like I say, total CapEx, we're probably, definitely under 5 million, which is not a normal number for mining companies, a very small number. I think we're going to see, some, additional developments in terms of the funding, maybe the participation of some of the industry's larger players, including maybe perhaps Tiffany's, Louis Vuitton, those types of groups. The supply issue is definitely going to play out. I don't think it's a problem right now, but I think as we get into the first and second quarters of next year, it will start to be something that everybody will be looking at. And so for us right now, we're fine to just sort of finish off this year, up to December 31st, and really the first quarter of next year we'll be back, getting going, getting everything prepared to ramp up, doing some additional bulk sampling, some work on those outside areas, and then return to sort of selling stuff, as we get into February, March, back to regular sales cycles. So we think that the prices will come back up, which will be nice. Big stones are always interesting. For us. So, when we look at it, Maurice, if you look at last year's fiscal year end, March 31st of this year, it was really, really too bad that we got hit with the power. Ultimately, the power situation with Eskom probably cost us about 4 months. If you look at the financials, we only lost about 750,000 Canadian last year, and we lost sort of the last 4 months. Due to the power situation. So, had that not happened, we were comfortable that we were in a pretty good trajectory to actually have a profitable year just from the trial mining phase last year. So this year, the goal is definitely, get things ramped up. And I think it's, like I say, while there's not much news and stuff like that goes on at the moment, I think as we get through these next couple of weeks and into the new year, we're definitely going to have some fun, and it'll get back to being, really quite a fun situation for us. So that's where we see happening.
Well, you somewhat answered my question, because myself as a shareholder and a number of shareholders have been asking, hey, when are we going to have you back on the show? So in terms of news flow, what can we expect in 2024?
Well, I think early on we'd like to, like I say, we were looking at doing a term loan type of financing. We announced we would do up to 5 million. At this point, I think that there's a good possibility that'll get modified. We don't want to get into a situation, especially with the current markets, where the interest rate is exorbitant or out of control. We've had a lot of discussions internally. The largest shareholders, much like what happened during COVID, if we need to do anything here ahead of any discussions with industry leaders or majors or stuff like that, I think that we'll probably look at, as usual, insiders management, the largest shareholders, we're prepared to sort of add, and put in some sort of a convert or other facility, increase our shareholdings type of deal. That's an initial thing. I think that, as we get into February, March, it'll be nice to see, the sales come back on. News-wise, again, when we look at the outside areas, next year is going to be a year where we really would like to complete all the, in conjunction with what we're doing in terms of volume increases and the continuation of the trial mining that generates revenue and even has the potential to generate some significant profit. We'll be working on those outside areas, and trying to sort of, get all those samples and that done, move towards an updated 43-101, and then ultimately use that information to, aid us in arriving at initial production decisions. So it's going to be an interesting year. I think, look, we're quite excited. I think, as we've seen, this has been, it'll also be interesting to see what happens with the Christmas numbers. Obviously there's some economics, in terms of the U.S. market, Chinese market, different things that are going on. There's a lot of, you've got inflation, things and that. We'll see what the situation is. Everybody thought that during COVID there would be absolutely no, luxury goods buying or jewelry or things like that. The world tends to kind of surprise people when it comes. People still get married, they still have birthdays, they still have anniversaries. So it can kind of surprise people. So if we have good numbers, at the Christmas and through till, Diwali and stuff like that, and we see a little bit of recovery on the, overall economically worldwide, I think that, we could see, some good movement here next year.
Well, my wife just had a birthday this month, and then we have Christmas, and here I am interviewing you, and she just nudged me on the shoulders as we're discussing diamonds.
Yeah. It's really something else that, no matter what seems to happen, people gravitate towards rarity, luxury items. There's no question. We could all happily drive, whatever kind of cheaper vehicles there are, but it seems like the general population, they want to buy the Louis Vuitton goods, they want to buy the Tiffany's, the Carats, they want to buy the Mercedes, the BMW, all that stuff. It's just human nature, and quite frankly, I think that we get caught in our own bubble. I travel obviously extensively throughout the world dealing with this, and it always astonishes me the amount of high net worth or higher net worth people that are out there. I mean, if you look at this current situation, if you look at what kind of yields you're able to get and what kind of dividends on stocks and that, I think with the market in general, we're seeing a lot of the high net worth individuals that normally fund companies in the junior space. They're more than happy to take no risk right now and take 5, 6, 7%. And you can't blame them. Now, as the rates stabilize and go down, or as guys, I think that there's a lot of money on the sidelines. And I think overall, the resource sector, I've certainly never seen it this low. And I think the key now is to pick companies that are undervalued. And, I think this entry point here is very attractive, to be quite honest.
Well, let's look at some numbers. Mr. Taylor, please provide the capital structure for Diamcor Mining.
We're about 128 million shares issued and outstanding, about probably 135 million fully diluted. So it's relatively tight. We obviously suffered some dilution during COVID when we did the 3.5 million. But the interesting part of that was, it was almost like it would be similar to what we would see in a rights offering, where really there was no change in the net, like for all the biggest shareholders. Everybody just, we ended up with more shares, but everybody, kept the same shareholding. Most of the guys have been in since day one. If we look at overall the share structure, between the biggest shareholders, management, all that stuff, I think we have to be, at least 40 to 50% of the stock is held, by 10, 15, 20 people. And, ultimately, you don't see a lot of selling from those groups. You see more accumulation than anything. So it's very, very tightly held. And really at this point, like I say, again, if we have to do anything ahead of a better deal, if we think that, to be fully funded next year, we could certainly look at doing it by getting going and ramping up and generating revenues. We can do it, if the if we have bigger luxury goods guys that want to be involved, that want to secure supply and things like that, that opportunity is there. But the share structure itself is, like I say, it's rather unique in terms of there's not, there's quite a large portion of it that's held by a very select group of guys that have been in since day one. And really, when we look at these levels here, there's nobody going anywhere at these levels. So really, it's all about executing right now. Price comes to value, and if we do our job and get this thing, I mean, we want to see profitability. We've demonstrated, like I say, in past years we're very, very close to that, even just at trial mining. So you start talking about 2 or 3 times the volume. Their operating costs come down, the revenues go up. It's pretty attractive. So the sooner we can do that, and the quicker we can do that, the better off we are. And the outside areas, like I say, that will help us in the long term, where we'll be able to look at saying to whether it's analysts or industry people or funds, hey, if we look at it and say we find 5 million carats, we know our average dollar per carat conservatively is probably $200 US. You're talking about essentially $1 billion plus in gross revenue without big stones. And I mean, typically, historically, if we look at it, operating cost per ton, we target under $5 a ton, so it's extremely low cost, and revenues, somewhere, $10 to $15 a ton. It just depends on big stones. Big stones can, if we go out even in the first quarter of next year, and we saw some stones last year, some 50s, 60s. We've recovered to date the largest 91.7. But if we get it's hard to imagine, but if we get a good 100, 150 carat stone, which is the potential is very real, and it's good quality, we could literally do our market cap in a day. So it is a bit of a disconnect. But like I say, price comes to value, and we're the first ones to admit that it all comes down to executing and demonstration. So a couple of good quarters next year of getting things moving, and I think we're off to the races.
Well, speaking of shareholders, you and I correspond offline, although we haven't conducted an interview, I think, since January, if my memory serves me correct. But I'm on record. I'll be on record right now, I should say. I've been an active buyer. I think I've purchased a couple 100,000 shares here, September, October. Yeah. You're aware of that. I believe in the value proposition. I'm excited about the coming year here with the number of catalysts that we have on the horizon. And it doesn't take much, as you referenced. And
it doesn't take much.
No, and a lot of the barriers that were there, ESCOM with the electricity, we've overcome that hurdle now, and it looks very intriguing, I should say, sir. I will be continuing to add to my position.
It's, look, it is a really interesting, I think the value proposition here is, it's a little bit silly, really, in my mind. I mean, I'm biased, of course, but we've, like I said, if you look at it, we've probably spent close to $100 million on this thing. This is not a exploration program. We have, 500-600 ton an hour plants. We have heavy equipment. We have housing for the guys. We've got underground pipelines to bring water in. Yes, we've got the power line, and should ESCOM get, sorted, we can go back to that. We've got backup power. I mean, the advantages we have, obviously Venetia is one of the largest diamond mines in the world. You literally, you pull up to the security gates of Venetia, and you either go straight through their security or you turn left and go to ours. I mean, we can land, jets on a paved runway for free at the site. We have access to every supplier there is. There's just a tremendous amount of advantage we have. And I think one of the things that, we would look at internally is, this is junior mining. We tend to be, sort of in a situation where, a guy is typically undercapitalized. And, I think that's obviously the case. Now, I do believe that we're going to, finally sort that once and for all, early next year. And that will be nice to get that behind us. I mean, we do have other opportunities. We're constantly looking at stuff, other opportunities that the majors may have, where we can increase, even further. We don't want to get defocused and start jumping around to various different projects just because we want multiple projects. But certainly, if something is near-term production capable and has good quality stones in it, then, we've got the buyers that will support that. So really the name of the game right now is we've survived through COVID, we've survived through ESCOM, now we've survived through, a rather difficult end of this year in terms of the diamond industry. But overall, I mean, next year we just sort of look at it and say, okay, well, there's not a whole bunch left here that can pop up and hurt us. So we just have to stay focused on what we're doing here. And then as we get this project up and running and get it moving along and that, then, the next thing would be to look at what makes sense in terms of additional stuff that can increase those revenues. But again, it's one thing at a time. It's one step at a time. And, like I said, we're pretty good at, surviving all these different variables and these unusual things that happen. We've proven that time and again. And I don't think this will be any different. We'll be there, for next year should things change. That's what we're really focused on right now is let's just make sure we're prepared to take advantage of what we think is going to happen next year. If it doesn't, really doesn't affect us one way or another. But if it does happen, which is what we think, then we're going to be in really good shape. But it's just stick to our knitting right now and be very, very strategic in terms of what it is we do and how fast we do it.
Sir, before we close, last question, and that is, what did I forget to ask?
Yeah, honestly, I think if I'm sitting in the crowd, the thing I always ask guys is, what keeps you up at night, or what do you think are the things that can go wrong? I think we've solved the ESCOM deal to a large extent. I think for us to go really fast, it's not a huge amount of money, but we'll definitely need to, do a $3 to $5 million dollar facility, or some restructuring of that, which I think can be done. I mean, myself, the biggest shareholders, if we were to do anything right now, I can tell you that, we would probably commit at least $1 million, $1.5 million ourselves to throw into that. So that we see as something that's going to happen. Grade is always something we look at, but we try and solve that, and that's the reason why we go volume. The larger the volume we do, the less grade variability really affects us. Finding big stones, how quickly you can find them, that's, something we look at, and how much is in that outer area. Again, we're trying to be conservative, saying if 50 million carats came off of there, let's say we try and find 3 to 5 million. There's some areas out there that we see as high potential areas where, who knows, you could find 10 million carats, 20 million carats. Anything like that you find in these high-grade trap sites where the diamonds have settled. And boy, I'll tell you, we would have an awful lot of fun if, we build a model on very, very low grade. I think the model for going forward is based on, a 3.5 carat per 100 ton in situ, number. To date, we're probably at about 7 carats per 100 tons. So we back it off. We've seen areas that are as high as 25, 26 carats per 100 ton. It's difficult to model those kind of numbers. If you get into an area even for 2-3 years, where you have high grade 10, 15 carats per 100 ton in situ, but things change exponentially. So like I said, those are the sort of the things in terms of what questions weren't asked. I think that's being very, very straight up with guys. Those are the things we look at, but none of them are really disastrous. I think we're in a perfect position now, and well, the market is tricky, and that seems to be the toughest thing right now. Making sure that whatever facilities we put in place, we try and do it in as non-dilutive way as possible. And if we have to dilute some, let's keep it to the main shareholders and make sure everybody stays at the same levels, because that certainly doesn't hurt us.
Well, Mr. Taylor, it's been a pleasure speaking with you. Wishing you and Diamcor Mining the absolute best, sir.
Yeah, you too, Morris. It's always good to talk to you. Any questions anybody has or whatever, they're always welcome to get a hold of me. And looking forward to the next year. Get through this one, and wishing everybody happy holiday season. And we'll look for a good 2024.
Likewise, sir, and all the best to you.
You bet. Cheers. Thanks.
The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice, or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.